the EGROW webinar series. As you are aware, we have done this series now for nearly 4 years. We have been very, very fortunate. When we started this series, we were on the beginning of COVID, and we were wondering how are we going to give the research-based policy advice to the stakeholders, especially the government. As you know, the think tank was established in 2018 with a clear objective of providing research-based policy advice. Now, we have been lucky. We have done more than 220 webinars so far. Also been lucky. We have had the privilege of listening to 3 Nobel laureates and bring a blend of foreign scholars and researchers and Indian scholars and researchers on topics which are contemporary to both our country and to the global economy. So we've been very fortunate in that context. We were also very fortunate that under Government of India's G20 presidency, we got to do a couple of webinars there also, and we did on the new international economic order, 11 of them. And on women empowerment, we were able to do 6. And on climate, we were able to do 6. Because of the pressure of contemporary issues, we could not have the stipulated 11 under the remaining 2, the women empowerment and climate. And we hope that in the next few months, we'll be able to complete that series also. Most of the time, we try to bring in contemporary issues. Now, as you know, there's an interest rate cycle change which is taking place. America has come out with a very big 50 basis point cut in their interest rate. ECB had done it earlier. Bank of England already there. And will India do it or not? That's the big question in everybody's mind. We had been thinking of this seminar on interest rate policy for some time. We were thinking also in terms of inflation targeting. How should the inflation targeting be in a young demographic country like India? Should it differ from the rest of the world where it is being practiced quite aggressively, say Bank of England? Or should we have our own concept of an inflation target, something like the flexible inflation target, which has been discussed in the Indian context? So these are some of the contemporary issues on which EGROW has been wondering, worried, and sometimes making recommendations that if the interest rates are very high, this could probably be hurting the investment cycle and economic growth. EGROW does have every 2 months, along with the Reserve Bank's monetary policy announcement, a shadow monetary policy committee. A shadow monetary policy committee with its members has also been expressing that maybe the interest rates have been little high than what they should have been. But keeping in mind the global scenario, the capital flows, one understands what the Reserve Bank is probably thinking about, and therefore keeping the interest rates at a little higher level than as an economist I would have expected. These issues are worrisome, concerning all of us. Today, we have invited Dr. Gurbachan Singh, who is an independent scholar, an economist of repute, writing and publishing extensively on many, many contemporary issues, to speak on the interest rate. Next week, we continue with our series of Punjab, growth, and the other states. And week after that, we visit the topic again and bring in inflation targeting, a discussion which will be chaired by Professor Ravindra Dholakia, who was himself a member of the MPC and is currently the member of the board of the RBI. So we have requested him 2 weeks from now to come and speak about inflation target. Today, we are focused on the interest rate, and the topic for the day is innovative, effective, and well-targeted interest rate policy. To speak on this, as I mentioned, we have Dr. Gurbachan Singh. He's an independent economist. He was previously visiting professor at Ashoka University. He has taught at Indian Statistical Institute, Delhi Center, JNU, and University of Delhi. His writings are primarily on the interface between macroeconomics and finance. The work is mainly in theory to explain the real world and to devise better economic policies. Besides publications in academic journals, he contributes substantially to Ideas for India and Business Standard. He published a book on banking crisis, liquidity, and credit lines with Rollage. Having done his new book on macroeconomics and asset prices, Thinking Afresh on Basic Principles in Policy, is nearly complete now. He received his PhD from ISI Delhi Center and MA from Delhi School of Economics. With this, I'm going to request Dr. Gurbachan to speak to us for about 45-50 minutes, and then we'll open it up for question answer session. With this brief introduction, Dr. Gurbachan, over to you, and we look forward to your thoughts on the subject. Dr. Gurbachan.
Thank you very much for having me on your webinar series. It is really nice to be here. So let me get started with the presentation. I hope you can see the slides.
Yes, we can.
Okay. So here is the introduction. So before I begin, let me say something, which is that this presentation is not about my views on what the Fed has done or what the RBI is doing currently. I have my views there separately, but this presentation is not about that. It is instead about the basic ideas behind the thought process in the interest rate policy as it prevails, whether it is in the US or Europe or India or any other country. So I'm making a departure, and I want to talk about what can be a completely different interest rate policy. So let me begin with the formal introduction to this presentation. The prevailing interest rate policy intervention is blunt, not very effective, large-sized, and non-transparent. And each of these terms will become clear as we proceed. A new interest rate policy has been proposed here. The proposed policy intervention is BEST. So where B stands for better targeted, E stands for effective, S stands for small sized, and T stands for transparent. So it is best compared to the prevailing policy intervention. This is what I'm going to explain in this presentation, why and how. So first, effectiveness of the prevailing interest rate policy. Consider for simplicity the standard textbook macroeconomic setting. Central bank has, let us say, two macroeconomic objectives: maintain full employment and low and stable core inflation. I will not consider cost push inflation here because the focus is on interest rate policy, and as we know, the central bank can hardly do anything about cost push inflation. The central bank has one main policy tool, the interest rate, and since it has two policy objectives, it faces a paucity of policy tools. So the central bank faces a trade-off, as I said. The prevailing policy is not very effective in achieving the standard objective of macroeconomic stability within the economy. And if we include the rest of the world into the picture, then the policy is even less effective. Here is a chart to show the federal funds rate from 1994 to 2024. And as you can see, there are large variations in the interest rate. The revision in the interest rate that happened by 0.5 percentage points very, very recently is not included in this figure. The Fed has not yet updated it, but it shows till very recently. So as we can see, the interest rate can vary considerably. And the point to note here is that the large changes in the interest rate are due to Fed policy. They are not due to market forces. And another thing to note here is that before 2001, 2002, the federal funds rate would fluctuate in the short run considerably. See this part of the diagram? Whereas thereafter, there are um, there are very calibrated changes when they happen, and in the meanwhile, the short-term interest rate is stable. And as it is increased, there is forward guidance, there are communications from the Fed, and so it is hardly surprising. This part also plays a role in what I'm going to say later. So earlier I talked about the effectiveness of the prevailing interest rate policy. Now I'm moving on to side effects of the prevailing interest rate policy, which is the more interesting issue, which doesn't get much attention in macroeconomics, at least the standard macroeconomics. Asset price fluctuations over and above those due to fundamentals and sentiment. An extreme example, the long-term US safe government bonds fell in price by almost half due to a jump in the interest rate roughly from 0.5% to 5% over the period 2020 to 2023 after the COVID. And related to this was banking instability, Silicon Valley Bank, SVB, and others. Some of them failed, some of them went through major losses in 2023, and this was related to asset price instability, which was in turn due to the interest rate policy. Next, variable mortgage payments, which lead, and the interest rates also lead to fluctuating home prices and instability in the construction sector. Think of the period before and after 2007 in US and Europe, when the housing sector, real estate sector in general, went through major ups and then major downs later. Then another effect of the interest rate policy is the international capital flows and the additional exchange rate volatility. An example of that is yen touched 35-year low in 2023-24. It touched 160 yens to a dollar. Then near zero interest incomes for long for the middle class, because the rich don't invest in instruments like bank deposits. This happened after the global financial crisis in 2007. More generally, and in countries like India, interest incomes for retirees, widows, non-government organizations, NGOs, resident welfare associations, RWAs, educational institutions, research institutions, etc., are also affected. And finally here, the interest rate policy affects short-term funding. So the short-term interest rate is stable, as I was mentioning when I explained the previous figure. The short-term interest rate is not just stable, it is somewhat predictable in the near future, which may be considered a good thing, but this encourages short-term funding. Think of the funding, amongst other things, for investment banks like Lehman Brothers around 2006-07. So even though their operations are long-term, they borrow short-term, monthly, weekly, even daily, and they keep rolling over the debt to save on the interest costs. But this is not in the interest of the economy. Now, I just talked about side effects. Now I'm talking about side effects and after effects of the prevailing interest rate policy. So first I will consider an example, a simplified story here, and then I will talk about the issue more generally. So what is the example? There was a recession in the US in the year 2000. Interest rates were reduced by the Fed to deal with that recession. But as a result of the reduced interest rates, home prices went up, and then the rest is history. We had the global financial crisis, GFC, and the Great Recession, 2007-09. But even after that, the recovery was slow and mild. So more generally, what happens is that when there is macroeconomic instability, then the central bank responds with its interest rate policy. But this has the side effect of asset price instability. And that asset price instability in turn affects macroeconomic stability. So notice here that we start from macroeconomic instability we have a policy to deal with it, but then later we end up again with macroeconomic instability. So we have a story here of side effects and subsequent after effects of the prevailing interest rate policy. Some idea about the literature here. So there have been impressive advances in dynamic stochastic general equilibrium models in the literature. However, after a point, advances, generalizations, greater details, and the pressure to be up to date within a paradigm can become a burden for innovation. In any case, though theoretically it's a major advance, its contribution to policy is not path-breaking. The policy proposed here is different, but it is consistent with several other writings in the literature, though for a different reason in each case. And I'm going all the way back to Pigou 1920, Keynes 1936, Tinbergen 1952, Milton Friedman 1959, McCallum 1999, Benjamin Friedman and Kuttner 2011, Jean and Koronek 2019, Jorda et al. 2013, and Kashyap and Stein 2023. Next, a different literature, though relevant here as well. Plethora of schemes, policies, so it adds to the complexity. So what the authors Adams and others argued in 2021 in Nature was that there is a need for subtracting some schemes, policies, otherwise you keep adding to the complexity. The analysis that I'm presenting here builds on my earlier work, 3 papers, 2014, 2015, and 2018. The presentation here is a subset of this author's forthcoming book, which Dr. Charan Singh mentioned. The book is Macroeconomics and Asset Prices, Thinking Afresh on Basic Principles and Policy. Scope of this presentation, macroeconomics, the focus here is on, as I said earlier, basic principles and policy. We will abstract from cost push inflation, fiscal theory of the price level, and inflation due to political economy and conflict. I'll also abstract from asymmetric use of policy over an economic cycle under the prevailing policy regime. So what happens at present is that the policymakers are more active during a recession than they are in an unhealthy boom. And this matters, but I will not talk about that here, but it has effect on public debt and subsequent slowdowns, including balance sheet recessions, on which Richard Koo has done extensive work. On asset prices, this presentation will abstract from factors like sentiment, tax laws, and undue restrictions on supply of assets like homes. So here I am touching on asset price instability only to the extent that it is a consequence of the prevailing interest rate policy. So a quote here from Milton Friedman going back to 1959. He says, there is confusion between what might be called the monetary effects of monetary policy, the effects on the stock of money, and the credit effects, the effects on recorded rates of interest. So the point here is that monetary policy and interest rate policy are not synonyms. Monetary policy is about money primarily. It is not primarily about interest rate policy, which is what we have come to believe these days. So what he is stressing way back in 1959 is that we should be careful and look at central bank as an institution that takes care of money, and it may or may not take care of interest rate, and the difference will become clearer as we proceed. So here's a slide on two concepts. One is the neutral interest rate, the other is the normal interest rate. We consider both in real terms. The familiar neutral interest rate and the unfamiliar normal interest rate. So even though normal interest rate is unfamiliar as a concept in the literature, it is actually quite familiar in daily life, in practice amongst practitioners. The neutral rate is low in recession and high in boom, as we know. It is variable over time. What is normal interest rate? Think of the normal interest rate as the average interest rate over a very long period of time. This is not to say that it's a constant, but it has little variability, much less than the variability in case of the neutral interest rate. Now, the neutral interest rate is desirable for macroeconomic stability, meaning it is desirable to get the market interest rate close to the neutral rate for the purpose of macroeconomic stability. But it's also desirable to get the interest rate close to the normal rate in the interest of stabilization of interest incomes, banking stability, and related banking stability as it relates to asset price stability and exchange rate stability. Excuse me. The prevailing policy steers the interest rate towards the neutral rate. Under the current prevailing policy, it does not matter very much if the interest rate deviates further away from the normal rate. However, the proposed policy in this presentation pays attention to both the neutral rate and the normal rate. How to correct a price? The price here is the interest rate. Now, in general, a price change can be implemented through administered pricing or a tax subsidy scheme. The idea of administered pricing is simple. The government dictates a particular price, and then the purchases or the sales or both can happen at that particular price. In case of the alternative tax subsidy scheme, the government imposes a tax, let us say GST, that in turn affects the price of a good or service. Similarly, it can be a subsidy which affects the price of a good or a service. So you can change the price through dictating an administered price, or alternatively through introducing a tax subsidy or changing the tax subsidy rates so that the price in the market gets changed. It is induced. Under the prevailing policy, price, interest rate here, price changes through what amounts to an administered price by the central bank. So when the RBI or the Fed announces an interest rate, it is really a case of administered price. Now, administered price includes an implicit subsidy or implicit tax. Why? Consider the case of a low interest rate. Suppose a low interest rate is set by the central bank. What does a low interest rate mean? It means that the borrowers are getting a lower rate, which means that they're getting an implicit subsidy on their interest cost. And if the central bank raises the interest rate, then it's as if the borrowers have been taxed by the central bank. So this is an implicit tax subsidy scheme through administered pricing implemented by the central bank. In contrast, under the proposed policy, the price interest rate changes through explicit tax subsidy scheme. And this is not by the central bank, this is by the Treasury or the Ministry of Finance. So here we have a major point of departure, a very major point of departure. Interest rate policy, not through the central bank, but through the Treasury or the Ministry of Finance. And the reason being that in one case, it is an implicit tax subsidy scheme. In the other case, it is an explicit tax subsidy scheme. Excuse me. So let's take first the case of recession or economic slowdown that we may call it in India. And for now, assume that the price level is given. So in other words, zero inflation, but we can more generally assume low and stable inflation rather than zero inflation. So here, let's consider the first table, which shows that the prevailing interest rate policy is blunt. In what sense is it blunt? The intention of the policymakers is to reduce the interest rate for real investment. Real investment is you set up a factory, for example, and the idea is to give a subsidy for real investment to borrowers. However, when the central bank reduces the interest rate, it is reducing the interest rate not just for borrowers, it's also reducing it for lenders or bank depositors. So since their income comes down, it is as if the central bank is implicitly imposing a tax on the lenders or depositors. So we have an implicit tax subsidy scheme, subsidy for borrowers and tax for lenders. Also, the scheme applies not just for real investment, it also applies for any financial investment. An example of financial investment, somebody like Warren Buffett or other investors, other such investors could borrow funds when the interest rates are low and use the funds to invest in stocks. Now, this is typically in the secondary market, so there is no new capital formation happening here, but it is a profitable opportunity for them given the low interest rate policy in a recession. So again, here there's an implicit subsidy for borrowers because their interest cost gets lowered. And there's an implicit tax on lenders or depositors because their interest income is got reduced. So since the idea was to affect only borrowers for real investment, but you are affecting the lenders and you are affecting financial investment, the policy is blunt. Now let's come to the second table, which is about the proposed interest rate policy, which is well targeted, as the caption for table 2 states. So here, the Treasury or the Ministry of Finance says that if you undertake a new project, if you set up a factory, for example, or any kind of real investment, then the Treasury or the Ministry of Finance will give an explicit subsidy to the borrowers for the purpose of real investment. But such a subsidy is not available to borrowers who want to make a financial investment. Also, such a subsidy or tax is not applicable to the lenders or depositors. So since we have a blank in the 3 boxes and we have an entry in just 1 box, which is why it is said here that the proposed interest rate policy is well targeted. Well targeted at borrowers only, not at lenders, and well targeted at real investment and not at financial investment. So the next set of 2 tables is about the boom. So there's an opposite tax subsidy scheme compared to what we saw previously. So in the interest of time, I will skip this just to say that it is the opposite of what we had previously. And here is a table that will explain the policy better. So here in the main body of the table, we have 2 columns, one for prevailing policy and the other for proposed policy. The prevailing policy includes an implicit tax subsidy, therefore it is opaque, it's not transparent. The proposed policy includes an explicit subsidy or explicit tax, and that makes it transparent. And here in the rows, we have 2 sets of rows. One set of rows is for recession and another set of rows is for boom. Let us first consider the case of recession. In the case of recession, under the prevailing policy, there's an implicit subsidy for borrowers and implicit tax on lenders, as explained earlier as well. And then there's an opposite tax subsidy scheme in the case of boom. So this is what covers the first main column in the table. Now let's come to the proposed policy. So in this case, in a recession, there's a subsidy scheme, explicit subsidy scheme for borrowers for real investment, but there's no tax scheme for lenders or depositors. Similarly, in a boom, there is no scheme which affects lenders and depositors, which is what makes it well targeted. Now, what we have is under boom, a tax scheme for borrowers. So the proposed policy is for borrowers only and not for lenders, which is why not applicable here and not applicable here. Again, to tie up with the theme that the policy is well targeted and not blunt. So let us understand better what is going on. In a recession, the market interest rate tends to be low. Why? Because the investment demand is low, savings are not affected much, but the demand for funds is low, so the interest rate tends to be low. Under the prevailing policy, the implicit subsidy for borrowers lowers the interest rate further. Why? Because you want to take it towards the neutral rate in a recession, and the neutral rate in a recession is low. Now let's come to the proposed policy. Under the proposed policy, the explicit subsidy can shift the demand for funds upwards. Naturally, if there is a subsidy which is available, then that will increase the demand for funds. And since the demand for funds is pushed up, the interest rate that is observed in the market rises. So it rises towards the normal level. Why am I saying rises? Because in a recession, the market interest rate tends to be low. So the policy is taking it towards the normal level. But since there is a subsidy, the effective or net of subsidy interest rate is reduced towards the low neutral rate in recession. So this slide is an important part of the presentation. So what it is showing is that the prevailing policy is about getting the interest rate towards the neutral rate, ignoring the normal rate, more or less, having to do that. Whereas in the proposed policy, the interest rate which matters for macroeconomic stability is indeed being taken towards the neutral rate. However, the interest rate that is observed in the market and which is relevant for interest incomes, asset prices, banking stability, exchange rate stability, that interest rate is being moved towards the normal level. Now, what about possible misuse of the subsidy? Here I'm considering the case of recession. So again, as in other tables, there is one column for prevailing policy and another column for proposed policy. And in the rows, monetary policy by the central bank, in this case, tax subsidy scheme by the Treasury or the Ministry of Finance, which is the alternative that is being considered here. Now, observe that under the prevailing policy, there is an implicit subsidy anyway for all real investment and all financial investment, right? And now, under the proposed policy, the explicit subsidy is for all real investment. But if there is some use, which is, by the way, not easy, but let us leave that issue aside and say that, well, there is possibly some misuse, and people take a subsidy, claim that they will make a real investment, but instead they make a financial investment. So it looks like a misuse, and indeed in a legal sense it is a misuse, but in an economic sense, we need to take at the larger picture. What is the larger picture? Under the prevailing policy, the implicit subsidy is anyway for all real investment and all financial investment. So even if there is some misuse, the subsidy is less here than here, which is also related to the idea that the proposed policy is small sized. Proposed subsidy or tax is small sized, whereas here the prevailing subsidy or tax is large sized. And here is the argument in terms of the good old ISLM curve, ISLM model. So this is the initial position, the IS curve, the LM curve, the income on the x-axis and the interest rate on the x-axis, and this is where we have the equilibrium initially at this interest rate and this income. This is standard textbook stuff going back to its 1937. Now, suppose there is some random cause due to which the IS curve shifts, then there is a recession, income comes down, but also the interest rate comes down. That's the important point to note here. And under the prevailing policy, which is expansionary monetary policy, the LM curve shifts out. You do get back to the initial full employment level of output, but notice that the interest rate having come down gets reduced further, which is where the story of the side effects and after effects of the policy comes into the picture. But under the proposed policy, it is not the LM curve which is being shifted out. Instead, there is a subsidy on the interest cost for real investment, and that shifts the IS curve back. So when you shift the IS curve back, you not only restore the output to the full employment level, you also restored the interest rate to the normal level. Now, this diagram, of course, shows a simplified picture where you reach exactly full employment and exactly the initial interest rate. But the point is more general, which is that you're moving towards initial output, you're moving towards initial interest rate. So here is a bit of math for it, but I will skip this in the interest of time. So let me go to this slide. What is the policy? Understand the policy better. The prevailing policy includes tax subsidy scheme, which is implicit in the interest rate policy of the central bank, which is or supposed to be independent in several countries. So this policy does achieve full employment. Why? Because we've assumed price stability. So therefore, there is one objective and one policy tool. So it's not hard to achieve full employment. But the policy is non-transparent. It is large-sized and with side effects for interest incomes, asset prices, and exchange rate stability, which is the story that motivated this work. Now, in contrast, the proposed policy includes two sub-policies, whereas here we have one policy. So the first sub-policy is explicit tax subsidy scheme by the Treasury to affect the interest rate under the somewhat mandatory advice from an independent advisory body. And so this we do not have at present, but it could be in place for implementing the proposed policy. A good way to think about such a separate independent body is an example of that is the Finance Commission that we have in India. Of course, the function of the Finance Commission is to advise on a different matter, but we could have a similar arrangement here so that the political pressures on the Ministry of Finance to do this or to do that are minimized, if not eliminated. And the proposed policy also includes use of base money by the central bank. So what is happening here is that we have two policy tools, one with the Treasury and the other with the central bank. Now, it is true that when you use the base money, that can also affect interest rates. So what that implies is that there is some interdependence between the Treasury and the central bank. But since there are two distinctive separate policy tools and two objectives, there is no issue of trade-off, and so the policy is more effective. I'll come to this part in greater detail later when we come to two objectives, but you can have a glimpse of that already. But what the two policy tools do here is that you can achieve the single macroeconomic objective of full employment given price stability, but you can avoid the side effects. Recall that the policy takes the interest rate observed in the market towards the normal rate, and it takes the net of subsidy interest rate towards the neutral rate. So this is what I was talking about earlier. Now consider two objectives. And since I've explained the other policy in detail, I'll be quicker here. So we have a column for prevailing policy and the other one for proposed policy and monetary policy. As we are familiar from textbooks, you consider the target, indicator or interim target, and instrument. Now, under prevailing policy, the target is low and stable core inflation and full employment. We're considering the dual mandate here. And the indicator or interim target, interest rate, in policy, in the media, in policy circles, this is called the policy tool, which in textbooks is called the indicator or interim target. And this includes an implicit tax subsidy scheme, as I explained earlier. This affects asset prices, which can affect consumption. And the instrument is open market operations. Now, fiscal policy, other than Keynesian fiscal policy, is not applicable here under the prevailing policy. Now, let's come to proposed policy. Here again, the target is low and stable core inflation and full employment. But the indicator or interim target is no longer the interest rate, it is central bank money. It cannot be the interest rate because that is in the domain of the fiscal policy now, but non-Keynesian fiscal policy. So here we have explicit tax subsidies seem to affect the interest rate. This affects core inflation and output, and then a separate explicit tax subsidy scheme to stabilize consumption. Note here that we have two objectives, low and stable core inflation and full employment. But now under proposed policy, we have one, we may call it policy tool, central bank money, and another policy tool, explicit tax subsidy scheme. And of course, the instrument is open market operations in both cases. So that is common between the prevailing policy and the proposed policy. So the idea here is that if you have two macroeconomic objectives, you have two policy tools here, which is why you can, in principle, avoid the trade-off. But it's not just a story of effectiveness of the policy for macroeconomic stabilization. It is also a story of minimizing or avoiding the side effects on interest incomes, on asset prices, on exchange rate stability. Let's come to short-term funding now. So under the prevailing policy, the implicit subsidy or tax is in the context of the short-term interest rate, as we know. As we know, the Fed or the RBI, they are working towards the short-term interest rate. The federal funds rate, which was reduced by 0.5% the other day, is the short-term interest rate. Now, what the Fed has done is to make the short-term interest rate stable, meaning that for the next 6 weeks, they've told you this is the interest rate. Of course, if it is an emergency, they may change it even then, but that very, very rarely happens. So it is for all practical purposes stable and even predictable, because they also tell you through their communications what they are likely to do when they meet next and even subsequently. So there is a long narrative on what can possibly come under what conditions. That makes it somewhat predictable. The downside of that is that it encourages short-term funding. The banks, the investment bank, even the large non-financial corporations want to save an interest cost. So even though their operations are long-term, they borrow short-term and keep rolling over the debt, given the stability and predictability of the short-term interest rates. But short-term funding can be very destabilizing for the economy. A good example of that is what happened in the year 2007. That was part of the financial crisis that happened in the US and in many other parts of the world. So this is not to be encouraged. Now, what happens under the proposed policy? The explicit subsidy or tax is in the context of real investment. Recall, the explicit subsidy or tax is not general, it's in the context of real investment. And in the context of real investment, it is likely to be more long-term borrowing than short-term borrowing. So it is meaningful to talk about the long-term interest rate here. What this implies is that the short-term interest rate is more or less market determined under the proposed policy. And then it is plausible that this short-term interest rate fluctuates significantly. Now that seems to be a downside, but note that fluctuations in the short-term interest rate can discourage short-term funding. So here, this is actually contributing towards a more stable financial system and even a more stable economy. Next, briefly on the zero lower bound on interest rate. Now, as we know, the interest rate cannot be reduced below zero. And that is true whether we have the prevailing policy or the proposed policy. So, is it possible to have a negative nominal interest rate? No, under prevailing policy, and no under proposed policy. But we can ask another question. Is it possible to have a negative effective post-subsidy or net of subsidy nominal interest rate? Now, of course, this question is not applicable here because we don't have such an explicit subsidy by the Treasury or the Ministry of Finance under the prevailing policy. But under the proposed policy, we have an effective post-subsidy or net of subsidy nominal interest rate. And that interest rate can be negative for the simple reason that if the interest rate is 3%, if you give 1% subsidy, 1 percentage point subsidy, you make the interest rate 2%. If you give 2 percentage point subsidy, you shift the interest rate from 3% to 1%. If you give 3 percentage point subsidy, you reduce the interest rate from 3 to 0. And if you give a 4 percentage point subsidy, then you reduce the interest rate from effective interest rate from 3 to -1. So the zero lower bound is not an issue here. Moreover, the prevailing policy involves implicit subsidy and quantitative easing. Now, quantitative easing has its own difficulties. The proposed policy involves explicit subsidy and no quantitative easing. So all this seems very favorable to the proposed policy, but there is a difficulty in practice. There is a story of vested interest and there is a story of mindset. The vested interests, there are two kinds. There are people who borrow at the low subsidized rate and invest in financial assets like stocks and do not make real investments. So if you change to the proposed policy, such a subsidy is absent for a large number of borrowers in the financial system. They tend to lose. Also, there's another category of vested interest, those who borrow for the short term, even though the operations are long term. They keep rolling over the debt. Such debt is huge. Now, their interest costs will also go up if you have a fluctuating short-term interest rate rather than a stable and even predictable short-term interest rate. So those are the vested interests in favor of the prevailing policy and the vested interests against the proposed policy. But there's also a mindset issue. And in fact, John Maynard Keynes had famously said that vested interests are important, but even more important in a change is the mindset. Now, what is the mindset issue here? Interest rate is a price that can be corrected by the central bank only. That is something that we are so used to. We feel that is natural, intuitive. Some may feel even axiomatic, inevitable, but that's not the case as I've explained in this presentation. So this is the conclusion from the presentation. The prevailing interest rate policy has serious difficulties. A new interest rate policy has therefore been proposed here. This policy intervention is best. B is for better targeted, E is for effective, S is for small size, and T is for transparent. as compared to the prevailing policy intervention. It is true that the institutional setup that is compatible with the proposed policy is different from what we have at present. So at present, the arrangement is that the central bank looks after money and the interest rate. And the Treasury or the Ministry of Finance is not involved, at least not directly, in the interest rate policy. But under the proposed policy, the institutional arrangement has to be different so that it is compatible with the proposed policy, which is that the central bank looks after money, base money as it is called, or reserve money as we call it in India. And the Treasury or the Ministry of Finance looks after the explicit subsidy or tax in the interest rate policy. Now, you need to change the institutional setup. However, in the long term, it is the underlying economics that determines or that should determine the institutional setup and not the other way around. We can't decide on the economics on the basis of what institutions we have as a historical legacy. So that's where I will end, and thank you very much.
Thank you, Gurbachan. This was fabulous and very theoretical. I must say that, and I must thank you for this presentation. Now, any questions? If you have a question, please raise your hand, or you could put it in the chat box. Gurbachan, I had one question in the, you have spoken about the interest rate policy, the 2-3 questions which I had in mind. One is, suppose there is a supply side shock, the type of shock that we faced a couple of years back when the Russia-Ukraine war took place. Now, when you have a supply side shock, how would you then handle the story? Because yes, the interest rate policy is doing corrective mechanism, but then there's a relationship between the interest rate and inflation. And if inflation is rising because of the supply side shock, how would you take care of that part? And the other question was that in the situation that we are right now, the interest rate differential between the US and India, and the concern basically is now of capital movement. You must have seen in all the newspapers today, 2 things have been reported from the Ministry of Finance. Chief Economic Advisor has said that this will have very little impact on the Indian economy. And the Secretary has also mentioned, and Chief Economic Advisor says this has been factored in. And the Secretary has mentioned that this is, it will not impact the capital flows, the interest rate. How do you, given this proposal that you have, how do you accommodate these two?
Okay, so thank you for the questions. So first, the supply side shock. So this presentation was abstracting from supply shocks. I was considering only the demand side of the story. But this is not to say that this is not an important issue. It is just that I was not dealing with that in this presentation. But I will take the question nevertheless. So in my book, I do deal with this issue. And in fact, the European countries have dealt with that issue, and my policy prescription somewhat overlaps with what has actually happened in practice in Europe. So in the European countries which were affected by the invasion of Ukraine by Russia, the energy prices went up massively. So what many European countries did was that not the central bank, but the Treasury intervened. The fiscal authority in many of these countries gave a subsidy on the energy cost so as to reduce the burden on the people and also to keep a check on the inflation in the economy. Now, where they got into difficulty with that was that the fiscal deficit went up, and as we know from Keynesian economics, when fiscal deficit goes up, there's an push to aggregate spending, and that was inflationary. So, in an attempt to deal with supply side shock cost push inflation, which they did manage to some extent, there was also a counter point which came from the implementation of the policy itself, which was that the aggregate spending went up, the fiscal deficit went up, and therefore the role that unconventional fiscal policy, as it has been called. We are familiar with unconventional monetary policy, which is quantitative easing. But European countries after the war introduced unconventional fiscal policy. Now, now this is where the answer is common between what I have to say and what the European countries had done. However, I go one step further, which is that as you give a subsidy to reduce the energy cost, and that increases the aggregate government spending, there is a need to cut on government spending elsewhere. I call it the reallocative fiscal policy. So a reallocative fiscal policy alongside the unconventional fiscal policy, so that you do keep a check on inflation and on the welfare of the people, but at the same time, you don't increase the fiscal deficit due to this factor, at least not considerably, and you manage the inflation better. So that's the answer to the first question. The second one. Now, India and US, you are absolutely right that the interest rate policy change in the US, it can affect capital flows, because when the interest rate is lower, then some capital can move into India, or it can be more attractive. So, and that can affect exchange rate. Now, in fact, I use this very point as a motivation for my alternative policy. So this is a side effect of the prevailing interest rate policy, because the policy is aimed at macroeconomic stabilization at home. In the US, they are concerned about inflation and output or employment within the US. That is their main concern. Similarly, for RBI, the main concern is macroeconomic stabilization within the home country, though we have some concern for the exchange rate stability as well. But it is in the nature of the prevailing interest rate policy, its very logic, that it cannot help in affecting the exchange rate. There's a trade-off. Now, of course, given that trade-off, you may take one view about what the central bank should do, and I may take another view on what the central bank should do. But that's a difference of opinion on how far the central bank should go. It is not dealing with avoiding the issue, dealing with the issue at its root, which is what the proposed policy does. So in the proposed policy, what would have happened is that in the US, the treasury there would have reduced the subsidy and not affected the interest rates much in the market, which is why the capital flows and exchange rates would not have got affected very much, if at all. So that's my answer to the second question that you posed. But outside of this seminar, I'll be happy to discuss even more along these lines.
Sure. How do you define the unconventional fiscal policy? Because they ended up increasing their deficits and borrowings and the debt, right?
Yes.
But within that, you mean there's a qualitative difference in normal fiscal policy and the unconventional fiscal policy?
So first, the conventional fiscal policy is the Keynesian macroeconomic policy. The unconventional fiscal policy that came up in the last few years in many European countries was that the government in each of those countries gives a subsidy on energy cost. So this was not about increasing the aggregate spending, increasing the fiscal deficit. That was not the objective. The objective was to give a subsidy to reduce the energy cost. So that came to be called unconventional fiscal policy. However, a side effect of that unconventional fiscal policy was that it increased the deficit and it increased the debt, as you mentioned. Now, what I am saying in my book is that the unconventional fiscal policy, as defined by these European countries, needs to be supplemented by a reallocative fiscal policy under which some other spending is cut.
Right.
So that you subsidize energy, but not get inflation out of hand due to such policy.
Yeah, but basically the point that you're making is that you have the Maastricht Treaty, you have a 3% of deficit to GDP ratio, don't breach that. And if you have a 60% debt GDP ratio, don't breach. So let there be allocation or reallocation sources, keeping in mind the upper limit. But they extended the envelope and they did it further. Okay. Thank you
Yes.
for that clarification. I think there's a question in the chat box which is interesting. Can we mix monetary policy with fiscal policy? Are they independently dealt? Can the government intervention in monetary policy? Can the government intervene in the monetary policy? Okay, that's a good question.
So, as I was saying at the time that I was making a quote from Milton Friedman, 1959, there's a small book he had. The book is called A Program for Monetary Stability. So there he's cautioning us that monetary policy is not the same as interest rate policy. The two are different. Furthermore, he went on to add that monetary policy is primarily about money. Interest rate is incidental to it. Interest rate policy is about correcting the market interest rate. Now, when you correct any price, you can correct it through administered pricing, or you can correct it through a tax subsidy scheme. Now, what I was showing was that under the prevailing policy, we have a correction of the interest rate through administered pricing, but such administered price includes an implicit tax subsidy scheme. And what we could do as an alternative is to have an explicit tax subsidy scheme, which is run by the Treasury or the Ministry of Finance, which is where we get into the domain of fiscal policy, but not the Keynesian fiscal policy. If there is a further question to that, I'll be happy to answer that.
That's interesting, Gurbachan, because normally the debt management office is with the Treasury, right? But here you are proposing a different setup.
So let me say something on the debt management. So at one time, the public debt management cell was within the central bank. Then they said that there is a conflict of interest, and so it needs to be taken out of the central bank. So in some places, it has moved to the Ministry of Finance or the Treasury, but in several countries, it has moved outside of both the central bank and the Treasury. It's an independent, separate body looking after that. So at one time, it was thought that public debt management can be only with the central bank. But of course, we know now that the central bank need not do this. In fact, it is desirable that it doesn't do this. So just as we have made a departure in the context of public debt management function with the central bank, we could similarly make a departure insofar as the interest rate policy is concerned. Now it's a big departure, but that is how we can avoid the side effects, and that is how we can make the policy more effective for macroeconomic stability.
See, before inflation targeting was implemented in England, the interest rate used to be fixed by the Treasury, and the monetary policy and money supply was by the Bank of England. So they brought the interest rate fixing responsibility on the Monetary Policy Committee at Bank of England. So if we say that the interest rate policy would move to the Treasury, how do you think inflation targeting would happen? Should
So,
the MPC move to then Treasury? Is that what you have in mind?
so, I'm going back to the basic story from Tinbergen, 1952. Tinbergen said that if you have two objectives, you need to have two policy tools, otherwise you face a trade-off, which is the story that we have in the central bank policy. The central bank is wanting to deal with two objectives, inflation and output, but it has one main policy tool, which is interest rate. So there is a trade-off issue. The attempt here is to get one more policy tools. Now, in the literature, there have been other attempts as well, but those other attempts were to look for a policy tool within the central bank, whether you consider it CRR or SLR or various other schemes, but it's all within the domain of the central bank. The departure here is to look for an additional policy tool outside of the central bank, and that is shifting the interest rate policy to the Treasury, so that we have two policy tools now. One is the explicit tax subsidy scheme to affect the interest rate by the Treasury, and the other is the use of base money by the central bank. Obviously, the central bank can no longer use the interest rate. It has to be with one institution. So I thought I would explain the issue in this way.
Okay, here are another two questions up here. Even if money is borrowed cheaply for financial investment, can we say it indirectly rolls into the economy as a side effect? This is in the chat box from Jairat Shinde. And then there is Vijay Kumar, who's asking a question. Please clarify the concept neutral and normal interest rate.
Okay.
They're both in the chat box.
Okay. Thanks for the questions. So, see, when you borrow money for financial investment, does it not end up in the real economy? So first thing, if you are borrowing money at a cheap interest rate, which means at a subsidized interest rate, implicit or explicit, then it should not be going for financial investment. The whole idea from 1936 onwards was that the interest cost should be lowered so that real investment goes up. But because the policy is blunt, in the process of giving subsidy for real investment, you end up also subsidizing financial investment. So it is not desirable. So since that is not desirable, we should not be doing it. But wouldn't it have some effect? Well, if it is going to have some effect, then why are we looking for some subsequent second order effect? Why not just look at subsidy for real investment only, so that you deal with the main issue? So that's the answer to the first question. Coming to the second question on neutral interest rate and normal interest rate. So firstly, both are theoretical concepts, unlike the market interest rate, which we observe in the market. Sorry. Neutral interest rate is a macroeconomic concept. The idea is that in a recession, the desired interest rate in the context of real investment is low. In a boom, the desirable interest rate is high, because you want to, in a recession, we want to encourage investment. In an unhealthy boom, we want to discourage investment. So that's the idea behind neutral interest rate. Neutral interest rate is a theoretical concept, low in a recession, high in a boom. And what the policymakers are trying to do is to steer the market interest rate towards the low neutral rate in recession and towards the high neutral rate in an unhealthy boom. This is the familiar territory. Let's come to what is unfamiliar territory. Unfamiliar territory in the sense that it is outside of the domain of the prevailing policy. But otherwise, we intuitively you all understand what is normal interest rate. So normal interest rate, as I said, think of taking the average of interest rates over a long period of time, real interest rates. In that sense, it is normal or usual. You average it over cycles, and you take one average. Now that indicates that it's only one average, but suppose the economic conditions have changed massively over 50 years, then one may take weighted average and give less weights to the observations in the past. And so one may have a slightly changing normal interest rate over time. But the point is that it is a lot more stable, much less variable compared to the neutral rate. Now, what are we trying to do here and how are they relevant here? Under the prevailing policy, when the attempt is to take the market interest rate towards the neutral rate, the idea is macroeconomic stability. And since we are taking the interest rate towards the low neutral rate in recession and high neutral rate in boom, unhealthy boom, we are taking the interest rate further away from the normal rate, which is where the story of the side effect on interest incomes, asset price stability, exchange rate stability comes into the picture. So what the proposed policy does is it says that let us have an explicit subsidy or tax so that you have a gross interest rate and a net interest rate. Take the case of recession. So the net interest rate is net of subsidy. The gross interest rate is when you are not taking out the subsidy part. So the gross interest rate is what you observe in the market, and that is being moved towards the normal rate so that you avoid the side effects on interest incomes, asset price stability, and exchange rate stability. And when you take the effective net of subsidy interest rate towards the low neutral rate, you are going in for macroeconomic stabilization. So this is how you achieve both macroeconomic stability as well as financial stability.
Very true. Very true. Thank you so much. In case there are any more questions, please raise your hand or put it in the chat box. I think there are no more questions. So I would like to thank you, Gurbachan, for your time and sharing this with us and telling us about the book which you are having, and you are talking to us about a new concept of the monetary policy. I really want to thank you for this. We will have the PowerPoint and the discussion on our website tomorrow by noon. I'm sure many of you would like to listen to it again because Gurbachan has brought a very interesting concept for us. Next week, we are continuing with our journey on understanding interstate differences in growth in our own country. In a way, we are learning from within our own country what the successful states have done and what Punjab as an illustration, which has fallen from #1 position to number 18 in the last 24 years. What has Punjab done or not done, and why is it losing its strategic position so strongly? So we have Gujarat next week. Same, no, time is little different. We are doing it from 5 to 6:30. I would like to invite all of you to please pencil in your timing for next week, Gujarat. Once again, let me thank the participants. Let me once again thank Gurbachan. For a long time. We wanted him to come and talk about it. And today he has shared his thoughts. And as I've mentioned to you, a week after on 4th, we are going to have discussion on inflation targeting in India. And I think what Gurbachan has spoken and what we discussed in inflation targeting, probably there'll be some similarities and some discussion, because at the end of the day, what matters most in an economy is the interest rate. So, and the inflation targeting also is bringing in the story of the interest rate. So with this, look forward to.
Just before you close it down, I really appreciate the effort you made. Thank you so very much for this opportunity. It was really nice to present it. I have presented it at several places, and each round of presentation improves my own understanding. I get questions, it improves. I thank all the participants. I thank also Vivek for all the work he has done here. Thank you all very much.
Thank you.